Okay, I believe that we are live. I'm gonna wait for a cue just to make sure. This is my first time streaming on this channel, so this is all new to me. So maybe you guys will be able to tell as we get um, some of the technical difficulties or anything out of the way.
Good.
Oh yeah, I think we are live then. Okay, so what we're going to be doing on this stream is that I'm working in partnership with one of the three largest CFA prep providers, UWorld, and we're basically just going to be solving a bunch of CFA practice problems on the topics of derivatives. And oh, excuse me. And so we're going to be going over Black-Scholes, the binomial option pricing model, and the other thing we're going to be covering is the option Greeks. So what I'm going to do is I'm going to go in and pretty much just start launching a test and start working through some problems. And you guys can feel free to leave some comments in the chat. And then we're also going to have the director of the CFA program from UWorld in the chat. He'll be live, and if you have any questions about anything, he should be able to answer some of your questions. And then in between problems, I can also take a look at the chat and see if there's anything that's specific for me to be answering. So I'm going to go ahead and basically create a test based on one that I used in the past. So I was looking at this one yesterday, and I just want to take the same test that I took yesterday. So I'm going to hit this copy test ID. I'm going to go over to create test, and then I'm going to be able to do this custom here. And then I'm going to enter this same ID by pasting it in there and hitting retrieve. And now I'm going to be able to just be able to take that same test. If I wanted to, I could have gone and looked at any of these, hundreds of practice problems and gone and built some custom test this way, just based off of whatever topic I was interested in covering. But we're going to go ahead and create this custom test. And now we're generating, and we're going to see there's going to be 18 practice problems that we're going to be working through today. So as we work through them, I'll show you different ways that we can find solutions to the answers that we might not already know the answer to. So let's just get started on the first one. If you're familiar with CFA Level 2, then you know the structure of these questions. Basically, they're going to give you like a whole bunch of words and graphs. And then based on that, you can kind of go from the top down to start answering some of these problems. So let's just get started off with the first one. Usually the beginning is like a whole bunch of just flavor text. And then once we get down to certain parts, you'll see that these questions tend to go in order. Like the first part will be in line with the first question. Then once we get to the second question, that'll be the next part. And then the third question will be the next part, for example, like that. So let's start off. There's going to be basically just this company that's a broker-dealer, and they're going to be using the Black-Scholes model. I don't think we need a ton of this flavor text at the top. So let's just read the very first question. So we see that this person is short 1,000 shares of high grade, which is the name of the company, their shares, just before the end of the trading session. If each option contract is for one share of stock based on the information in Exhibit 1, the number of high-grade 30 puts Young needs to sell to create a delta-neutral hedge is closest to. So when we see that it says 30 puts, that refers actually to the exercise price. So, and we can see in Exhibit 1 that X is the exercise price as well. So we're looking at these 30 puts. We're looking at the puts with the 30 exercise price. We know that he's short 10,000 shares. So I've prepared something over here. So if this person, I think, is this the same? No, let me open up the exact one that we're going to need real quick. This one here. Okay. So if they're short 1,000 shares, basically every single share, one share is going to be equivalent to having a delta of 1. So if there's 10,000 short shares, that means that this would be, if you were long one share, you would have a delta of 1. But because they're actually short, that is going to turn into a delta of -1. So their current portfolio delta is going to be equal to that -1 delta, because they're short the shares, times the number of shares that they have, which is going to be 10,000 shares. So their current portfolio delta is going to be equal to -10,000. So this question is asking us to create a delta neutral hedge, which basically means that we need to get this portfolio delta right here all the way to 0. So how can we actually do that? Well, basically what we need to do is we need to take an offsetting position that has positive delta, because our current portfolio has negative delta. So if we were to long a put, buy a put, puts also have negative delta. Just like being short a share has negative delta, buying a put has negative delta, but we need positive delta. So that's why we're actually selling puts in this scenario. But how many of them are we going to buy? Or how many are we going to sell? Well, we need to know what is the delta of the put. So we can do that by using this formula right over here, which is going to tell us how to calculate a put options delta. And so let's just start off by working through this, and then we can talk a little bit about what delta even is in the first place. So we're given this n-d1 in this formula, but if we look up to the inputs we were actually given, we don't have n-d1, we only have nd1. So we need to figure out how we can get this value from there. So let's walk through that. So if we look at what an n-d1 really means, basically this is going to tell us if we have essentially a standard bell curve of possible distributions and outcomes of returns, what percentage of the time do we expect an option to say end up in the money? That is a loose interpretation of what it means. So if the nd1 is saying that, let's say we chop it off right here, and it's saying that 64.62%, I'm grabbing that from right there, of the observations fall onto this side of this line, of this probability of an option being expired. Then n-d1 should just be what's left over. What's the rest of the possible outcomes? So for our n-d1, we're just going to say that it's equal to 1 minus this value, which should give us a value of 35.38%. 35.38%. So that gives us our n-d1. Oh, sorry, that's incorrect. My bad. Oh, yeah, we're good. 35.38%. Now we can plug it into this put option delta formula. So it's going to be put option delta is equal to, and then it will be negative e to the negative, and then this little symbol right here is the dividend, like the continuous dividend payments, which for this we don't really have any continuous dividend payments. So we can just put 0 for that, and then we're multiplying it by the time to maturity, which is t. So that's going to be a value of 1 right there, and then we multiply it by this value of the 35.38%, which is going to be equal to this right here. If you put anything to the value of e to 0, it's just going to become 1. And I'll show you how we can see that on the financial calculator. So if you have like a TI BA2 Plus financial calculator, it'll look something like this. So if we just take 0 and then we do second and then this little e right here, it's going to come out to 1. But we have to take the negative. And then that's going to be a negative 1 multiplied by this, which is a negative 35.38% here. Now, so that's basically our delta, negative 0.3538. And now we can figure out that if we have this negative value for this put option, how many do we need to sell to get to a delta neutral portfolio if we combine it with our 10,000 long shares, which is going to be equal to, if we take the 10,000 or the negative 10,000 over the negative 0.3538, because we have to sell more than one put option for each single share because it doesn't match up to that full delta of 1 for each individual share. That's going to be about 28,265 shares. And so we can look up and see that that is one of our available answers, answer C. One thing that we should cover maybe real quick is just what is delta. So we could define delta as the change in the value of an option given a small change in the value of the underlying stock, holding all else equal. For example, the delta of a long position on one share of stock is +1, while the delta of a short position on one share of stock is -1. So let's go back over to our test software and then hit C and hit submit and see that we got it right. And we'll be provided with essentially just a little answer about this problem. Now let me go and just check over and see if we have any questions or anything yet. Okay, so we do have one question. We do have one question, which is how to get the Black-Scholes-Merton outputs. Right now they are just given, but how do I determine those in real life? Okay, I'm assuming that this that you mean inputs, like the inputs to the Black-Scholes in terms of not the outputs, the inputs, right? Okay, so I'm going to assume that even though you said outputs, that you mean inputs. So these values right here, like, or do you mean, oh, okay, he means these outputs down here. Okay, so how do we get these? So this is a little bit more complicated, and actually it's a good question because we're going to get into that. Like we'll actually start calculating D1, ND2, D2, ND1, ND2. So hold that thought for a few of the questions in the future. So we actually have a formula that we're going to use, and I've shown how to do this in Excel before in previous videos, but I'll get into that in a second here. And it's just, there's formulas that we have to follow that we will follow. It's basically just some complex math, and I hope we can, if we move through the questions, we'll basically get to a point where we can answer yours. So let's move on to the next question. This one is going to say, Young intends to sell calls to construct a delta neutral position in pure platinum, but is concerned about her ability to manage the position. If each option contract is for one share of stock and the pure platinum stock price increases by €5 over the first few minutes of the next trading session, which of the three options shown in Exhibit 2 will leave the position closest to delta neutral? So this is where we're going to look at this Exhibit 2 down here. And so there's going to be these three stocks. We see one has a strike price of 40, one has a strike price of 50. Or I should say we have three options. One is strike 40, strike 50, strike 60. The current price of the underlying stock is $55. And then they all have these delta values and these implied volatilities. So we're wondering about if each option contract is for one share of stock and the stock price is increases $5. So basically, if this stock price goes from $55 to $60, which of the three options shown in Exhibit 2 will leave the position closest to delta neutral? So this is actually a question that's really going to be related more to the Greek of gamma. And so I'm going to open up the next one that I had planned for this question. So basically, Gamma, and I got this from UWorld's chapters of their readings. I'm going to just read the definition and then you'll understand maybe why gamma is really what we're being asked about here. So option gamma is defined as the change in an option's delta given a small change in the value of the underlying stock, holding everything else constant. So option gamma measures the curvature in the option and the stock price relationship. So essentially with option gamma, it's going to tell us how much the delta is changing when the value of the underlying stock moves. So if we're looking at a position that we made delta neutral because we matched up the deltas between the shares that we had in a certain position with the options that we had, if the shares are always going to have a delta of 1 no matter what. If the price moves up and down, the delta never changes. It always has a delta of 1, whereas option delta is constantly changing, and it's going to be changing based on gamma. And so here's actually a graph that I created myself. So I have this Excel spreadsheet that I made where I calculated basically all the option Greeks for various strike prices on a specific stock. And this is just the option gamma. So these are my real calculations. So what you'll see is that if this stock price was set at 40, this is going to be the gamma if we hold everything else constant. If we hold all else constant, we see that the gamma will peak when the stock price is closest to the strike price. So option gamma should be the highest for at the money options and the lowest for options that are out of the money. So if we're getting further and further into this out of the money area, either high or low, the option gamma will be less. So if we're wondering about which option is going to have the closest delta even after price changes, meaning that delta is going to have changed the least even after price changes, it would be the one that is the furthest from the at the money option, the one where the strike price is the furthest from the stock price. So if we look at these, if this changes from 55 and it goes up to 60, like increasing $5 in a few minutes, then this one, option 3, is going to be at the money. It's going to be the difference between the strike price and the stock price is going to be 0. This one, if the price is 60 and this is 50, it's going to be a difference of 10. And this one is going to be, if the stock price is now 60 and this option has a strike price of 40, this one's going to be 20 away from that. So the one that's furthest away is going to have the lowest gamma, meaning its delta actually changes the least. So we would go with option 1. So let's go and punch that in here. All right, there we go. So we got that one correct. We're going to see, one thing I like about this QBank a lot is that there's a lot of detailed answers about if you like get the question wrong and stuff that make it pretty clear what you did incorrectly or what you may have been missing. I'll check and see if we have any comments before I start on the next question. No? Okay. Looks like we're pretty good for now. So I'll keep moving along and just start on the next one. So the next one says that the values given for implied volatility of the pure platinum options in Exhibit 2 are most appropriately estimated using. So let's take a look at just like what we're even talking about. So we're looking at the same option table once again. We have these 3 options, and then we do have this implied volatility value for each of these different options down here. So the values given for the implied volatility of pure platinum options in Exhibit 2 are most appropriately estimated using, and then we have the Black-Scholes-Merton model and the market price of pure platinum options as a possible answer, the standard deviation of projected returns on pure platinum common stock, and then the historic price volatility of pure platinum options with the same strike price. So I'm going to open something that I prepared for this question really quick. And this one I actually think is pretty interesting because implied volatility is pretty interesting. So how are we coming up with these values of implied volatility? Well, with Black-Scholes-Merton, this is kind of one of the more interesting, like, complex things about it. So you have these inputs, right, which is the price of the underlying, then you have the strike price, then you have the risk-free rate, you have the time to maturity, and then you have volatility. And then we pass all of these 5 in as inputs, right? So we pass all 5 into the Black-Scholes model, and then that's going to give us an output, which is just going to be the price of the option. So we could say we'll just say option price. It could be a call or a put. Well, I shouldn't be saying other words while I'm trying to write something else. So option price. So now, once we have this option price, you would wonder, okay, well, how did we get all of these things? Well, this is immediately obvious. This is just, we can look at the current stock price. It's really easy to find. This is really obvious. What is this exercise price of the option? Super easy to look at. What is the risk-free rate? We could look at whatever, like a 10-year treasury or something like that, and that'd be totally fine. What is the time to maturity of the option? Also really easy to look at. The one thing that's difficult, though, is what is the implied volatility or volatility of the option? That is not obvious, and we can't really look at it directly. So the weird thing is that this value, this volatility input, actually comes from this. It's almost like a bit of a circular reference, right? Where the option price depends on the implied volatility, and the implied volatility depends on the option price. So let's go through a really quick example of how we would even do this. Like, let's say, figure out what is the implied volatility. So this is a real life example that I took from Fidelity's Active Trader Pro, where basically this is NVIDIA, and the NVIDIA has a whole bunch of calls that have 375 days to expiration and a whole bunch of different strike prices right here. So we have all the different strike prices, and then we'll see that there's actually different implied volatilities at the different strike prices of the options. So this would be the implied volatility of the stock NVIDIA, not necessarily the options. So what's weird about it is if you look at these implied volatilities, they differ by each strike price, which you would think it's one stock, it's just NVIDIA. Why would there be different implied volatilities for the same stock? Well, that's just because these implied volatilities are based on the option prices, which might not always be the same value depending on each strike price, because the market can be a little bit irrational at times. So when I took this screenshot, NVIDIA's price was $149.43. That's the underlying price. The strike price of one option that I'm going to use in this example is 150, and then the time to expiration was 375 days. So I just took 375 divided by 365. And then the risk-free rate at the time, I just went and grabbed the 10-year treasury rate, which was actually 4.171% when I did this example. So this is actually going to be coming out in a future video on implied volatility on my channel. I just need to edit it and stuff. I think it'll be a good one. And so how would we determine what is this volatility? Well, we can see that this call is priced right now. The market is pricing this call at $32.75. So I can actually go into data here, data analysis, or no, I think I must have disabled this for an example in a different video. So I'm going to hit customize ribbon, add-ins. I'll go, Excel add-ins, and then I'm going to get the solver. How did I miss that? I clicked on it and it didn't get checked. So customize, add-ins, go, make sure solver's there. Okay. So now let's actually work back to the implied volatility based on this price. So we're going to set our objective of I3, which is the call price, to a value of the price that the market is putting for this stock, which is $32.75. And we're going to do it by changing this volatility here. And then we can hit solve and OK. And then we see that the market, basically based on our Black-Scholes model that I replicated in Excel, is going to say that the implied volatility should be 50.85%. So that is going to be pretty close. The one thing that I might have done differently than Fidelity Systems is maybe they used, instead of like a 10-year treasury, they used some other risk-free rate. But anyways, that's sort of a long-winded way to say that the answer is that the implied volatility is going to be most appropriately estimated using the Black-Scholes-Merton model and the market price of the options. So that should be our answer A. And sorry, there's a whole bunch of people leaf blowing outside of my apartment right now, so I'm not sure if it's showing up on the audio. Okay, maybe that's just for me then. That's pretty good. Okay, so we got that one correct. I'll take a pause here and see if there's any other... No, we're good? All right. Then I'm going to keep it moving, and we'll just go to the next question of what we got lined up for today. So let's look at this one. Regarding the strategies for writing calls on code shift shares, which of the following is most likely an advantage of strategy B over strategy A? So let's just look at what these strategies even are in the first place. So this next problem is going to be on all of these, all this text over here. I guess I can just read some of it for context. So this person works at this company. They hold 200,000 shares. So they hold 200,000 shares. They're long of the underlying stock. The shares were acquired through a round of venture funding before an IPO. The code shift shares are subject to a lockup agreement that expires in 6 months, so they can't sell them for 6 months. And then we see all this information about these shares. So we got 6 months to expiration, 2 months to expiration on these call options, and some different values for them. So they're looking at 2 different strategies. So Philip intends to sell the code shift shares as soon as the lockup period expires. In the interim, Phillips decides to sell call options against the shares to generate income. 2 different call writing strategies are being considered. So that's the question. We have strategy A, which is to sell 200,000 at the money code shift calls having 6 months until expiration. Or we can do strategy B, which is to sell 200,000 at the money code shift calls that have 2 months until expiration. When those options expire, sell another 200,000 at the money options that have 2 months until expiration. And then when the second group of options expires, sell another 200,000 at the money call options that have 2 months until expiration. So this one is kind of an interesting one, and I think it's a good one in terms of like understanding the intuition behind how options work at greater depth. So strategy A is basically saying we have, let's say we draw a timeline, and this is today, t equals 0, and then this is going to be t equals 6 months from now, or a half a year into the future. Strategy A is like, let's just buy a call option that is going to cover this entire period to hedge for us. Whereas strategy B is like, let's sell like 1/3, then let's do another 1/3, and then let's do another 1/3 like that. So regarding the strategies for the options, which of the following is most likely an advantage of strategy B over strategy A? So a more positive gamma is one option, a greater rate of time decay is the next, and less sensitivity to code shift stock price changes. So there's something that's sort of interesting about how all these options work with time decay. This is going to get into the Greek known as Theta, right? So options lose value as time passes. So an option, everything being held the same, should have more time value of money essentially when there's more time to maturity. And the way that it loses this time value is not linear. So if we draw a graph, which is used to basically approximate how much time value we have on this axis, and then on the other axis, we are going to have the time to expiration. Then we'll see that, let's say, if we start off at 6 months over here, and then we go all the way to 0 months down here. Say in the middle is like 3 months. So we'll see that it actually loses time value kind of like this. It's almost like an exponential fall off. So if we just do strategy A where we buy this, we're going to have basically the slowest rate of fall off. Whereas if we come in here right at like around the 2 month mark and we just keep buying right here, we're going to see that this time value is going to be falling a huge chunk 3 separate times. And so when you're the one who's writing calls, so we see writing really means the same thing as selling calls, that means that you're actually going to benefit from the time decay. You want more time decay because you don't hold the shares. Or sorry, you don't benefit from the option having more timed expiration. You actually want this option to expire out of the money if you wrote it. So we are going to benefit from a greater rate of time decay if we just keep doing this 2 month thing where we just get to benefit from this collapse in time value over and over and over 3 separate times. So let's say B for this one. And that's similar to the graph I drew there. Nice explanation over here. And then we'll go move on to the next question if we don't have any comments in the chat. Oh, we do it. Okay. If you guys have anything that you're wondering about, feel free to ask in the chat because I'm here to answer the questions. And also we have Sam Gottlieb, who's the director of the CFA program at UWorld. One of the 3 biggest CFA prep providers is in the chat live, and he's there to answer any questions you might have. So even if there's some questions that are like outside the scope of what I'm working on right now, you know, you can feel free to ask them, whether they're for me or if it's just something that, you know, Sam could answer if you're a CFA candidate. So with that being said, I'm actually going to just move on to the next question. So regarding the strategies to write options on code shift shares, if there is an upward parallel shift to this term structure of volatility, what strategies options are most likely to incur a larger immediate decline in value? So this one, I thought when I was like going through it, actually to me seemed like the hardest one of all of them. And so basically we can look at just like a really quick example of what the term structure of volatility is in the first place. So I'm going to just open up what I had prepared for this one over here in question 5. Okay, so this is a question that's basically getting into the topic of Vega. So let's just talk about Vega for a second, which is another Greek. And I grabbed this from the UWorld readings. They have these nice, like, concise readings for every single topic that basically is just going to make it so that you can spend less time reading from the curriculum. I would say it's almost like a 1-to-3 or 1-to-4 ratio, where if the curriculum has like 4 times the text on something, it's like summarizing it in almost like 1/4 of the text. So it's like a little bit easier to read. So Vega is the option Greek that measures the sensitivity of option values to changes in implied volatility. What Vega is usually expressed as the change in an option's value that results from a 1% change in volatility. So what that means, it's for calls and puts. Vegas should be positive for a long call or a long put. So if we go back to my calculator over here, we'll see how with delta, I have call delta in blue, I've put delta in orange. Whereas like option gamma, it's all blue. Option theta, put theta is orange and call theta is blue. And then option vega is just blue. So on these lines where you see only, on these graphs where you only see one line, that means that the call and the put have the same value as one another, whereas the ones where there's 2, they're different. So for option vega, it should be positive if you're long, because when you own an option, you want more volatility essentially, because with more volatility with options, you're really like betting for the tail events. You want like huge price changes because you benefit from it going a certain amount past some strike price. So we want more volatility. So with these Vegas, we're going to see that, like with this call option, let's say just as an example, this one, if the implied volatility were to go up, let's say from 24% to 25%, then the price of this option, this measures the sensitivity of the option's value to changes in implied volatility. So then we should see the price of this option go up by about 18 cents from that 11.50. So the question's getting at, if we do that 6-month thing where we just buy for 6 months on strategy A, versus if we keep rolling 2 months, what's going to be, which one is likely to incur a larger immediate decline in value if there's an upward shift in the term structure of volatility? Which strategies options are most likely to incur a larger immediate decline? And so if we have this implied volatility curve, where basically the shorter timed expiration options have the higher implied volatility, which we see from this right here. We see that the 2-month has a higher implied volatility than the 6-month, which has a lower implied volatility. That would imply, and we see that the Vega is higher for this one. That means that this one is going to be more susceptible to these changes in Vega. And so if we're selling, we actually lose when the implied volatility rises, right? Because we're short on these options. So this higher Vega is going to be bad for us. So for us, we're going to say that the one with the higher Vega and this higher implied volatility, unfortunately, is going to be the one that is going to be more penalized, I would say. So I think we're going to go with strategy B on this one. Let's go with that, which is the rolling 2-month one. And that's where I got that graph from and the definition, if anyone was curious. Let's see. Do we have anything yet? All right. No more, no questions at this time. So I'm just going to jump into the next one. So in this one, we're asked, which of the following trades will most likely create a delta neutral hedge with a positive gamma for the short position in nano node shares? So there's basically a sentence all the way at the bottom. Philips also has a 50,000 share short position in Nano Node Semiconductor Inc. Philips decides to use nano node options to construct a delta neutral hedge that has a positive gamma. So we've got 50,000 share short position, and we're going to use the options to construct a delta neutral hedge that has positive gamma. So if we're short shares, and let me just open it up so I'll write some stuff down over here. So if we're short 50,000 shares, right? Short 50,000 shares, that will imply that our current portfolio delta is going to be equal to negative 50,000. Why is that? Because it's going to be the 50,000 shares multiplied by the -1 delta for each share. Each share has a delta of 1, and if we're short, that means it's going to be negative. So we need to get this to 0. How are we going to do that? So we basically have 3 separate options to choose from. One of them is buying the nano node puts. Now, if we buy puts, is that positive or negative delta? Well, puts have negative delta. So if we're long puts, that's going to give us negative delta, which would actually make our portfolio delta even more negative than that. Now, how about sell nano node puts? Well, that would have positive delta, right? Because we're actually selling the positions that have negative delta. However, if we're selling them, then what does that say about our gamma? So we want to have positive gamma, a net positive gamma. Now let me go back to this calculator over here. So we can see that both calls and puts, right? Because I'm not separating the lines out. Both of them have positive gamma. So if they both have positive gamma, what does that mean if we long them? That means if we long a call or long a put, that would give us positive gamma. Whereas if we short a put or short a call, that would give us negative gamma. So that if we sell the put, that would give us negative gamma. So that's not going to be sufficient if we want to end up with positive gamma. Now, how about the last option? So when you buy calls have positive delta, so that gives you positive delta. Whereas if you shorted a call, that would give you negative delta. And because we're long a call, like we just said, that'll give you positive gamma. So that does the perfect thing. Buying a call will raise our delta and our gamma, which is what we were hoping to do in this problem. So we would go with the answer C for this one. So let's try that out and see what we get. And this right here has a nice table, which I'll pause on for a second, which kind of just shows the different gamma, like positive or negative values for different positions, as well as positive negative values for gamma. All right. Sorry, my voice is going out a little bit here, guys. I never talk for just 40 minutes straight. And maybe you guys can't hear, but it is kind of ironic that the first time I go live, there's like a crew of people blowing leaves like directly outside of my window. Hopefully my mic is like not capturing that for you guys. So anyways, let's just move on. So basically we finished the first vignette and now we're going to move on to another story. And this one is going to be, it's going to be about Black-Scholes. And then we had that question earlier that was about like the Black-Scholes outputs. And this is where we're going to get into more information on these Black-Scholes outputs. So let's just start off by doing the first question. If we want, I guess we could say a little bit about what's going on in this story. So there's some firm, they offer services to high net worth clients, corporations. They're looking at this Elephantine Airlines common stock. It does not pay a dividend. There are no exchange traded options on Elephantine. Several of the clients have asked to evaluate the OTC options, and we're going to use Black-Scholes-Merton to basically analyze these things. So our first question says, which of this person's statements concerning volatility and the Black-Scholes model is or are incorrect? So let's go look at these statements. So this is just some thing about how they're talking to each other, and then they make these two statements. So statement one is that the Black-Scholes model implies the volatility surface is flat and fixed over time, whereas implied volatility arises across strike prices and expirations and changes over time. Whereas statement 2 says implied volatility provides a means of comparing the relative value of different options on the same underlying. So let's go and let's just see what I've prepared for this one to see how we can deduce which of these ones might be correct. So in order to answer this question, really we should talk about what is this volatility surface in general. So this one is going to be, I think, probably one of the most complicated ones that we're going to cover today. So let's talk about, there's some things we need to basically understand what a volatility surface for options is. So the first would be basically like a volatility curve and a volatility smile. So we have this graph with implied volatility, and then we have a strike price over here. So if we hold all else the same for an option, like the timed expiration, the risk-free rate, and what's the last one I'm missing? Anyways, I'll think of it later. Oh, underlying price. So if we hold all those the same and then we just look at volatility and strike price, we're going to see in reality, usually there's something that represents this volatility smile, which kind of shows like as like strike price decreases, the implied volatility gets higher. And then once we get sort of towards the middle, the implied volatility gets lower, and then once the strike price goes back up, the implied volatility is higher. So it looks like kind of like a smile, right? So that's why it's called that. And then we can basically take this from almost like this one-dimensional, or is this two-dimensional, one-dimensional? I'm not really sure. This format, and then add a third axis to it, where see now we have the implied volatility, and then we have the strike over here, and then we're just going to add one more like axis to this graph, which is going to be the time to maturity, and then plot it this way. And then so you'll see typically in reality, this is going to be more reflective of perhaps reality, where this volatility surface, which we're talking about here, is not flat. However, with the Black-Scholes model, it is actually going to assume that this is flat. So this statement is actually correct, that it is assuming a flatness behavior to this. So we can say that option one, or statement one, is correct. There are a lot of bad assumptions about Black-Scholes-Merton. There's a lot of things that it assumes that don't really hold in reality. And then statement two says implied volatility provides a means for comparing the relative value of different options on the same underlying. And that's totally true. Remember what we talked about with implied volatility earlier, where we were looking at the different call prices over here based on the different implied volatilities. Everything else is held the same other than the strike price. So that's how we can compare the prices, is that it's just going to, a big part of it's going to be how the implied volatility is going to deviate. So both of these should be true. It's a little bit complicated, and we'll go with both statements. So let's go back in here and click C for our answer on this one, and we get that correct. And you can see where I grabbed some of this stuff. There's a nice, more in-depth answer than probably what I said for this one over here. And if there's no questions, I'll just move on to the next problem in a second here. I'll give you guys a second to read it while I take a sip of water. Okay. For this one, we're asked, based on the information in Exhibit 1, which of the following is the most appropriate approach for valuing 50 call using the Black-Scholes-Merton model? So Exhibit 1 is right here. We have all our inputs, we have all our outputs, and then we've got these three questions. So, or these three possible answers. So the question from earlier where we were asked, how do we get these Black-Scholes-Merton outputs? Usually they're just given. This is where, on this part of this one, is where we're going to start actually getting into the weeds a little bit more on that answer. So that's why I saved this for later. So I'm going to open up what I prepared for this one so we can start writing some stuff down. Okay. So let's go and access. One thing we need to know is basically how can we calculate these values for these outputs. And I'm going to assume that most people haven't memorized this. If you're taking the test, you probably should memorize some of these things. For the rest of us, we're not going to have memorized it. So one thing I like about the UWorld product is that there's these simple sheets in here, which has this like nice concise answers that basically will give you all of the formulas that you really need to know for the most part, all in one single location. So I'm going to scroll down here and actually just try to go and find the derivative section, right? Because we have like 10 sections to this test. Okay, I found derivatives. And now I'm just going to go find some information on the Black-Scholes model, wherever that might be. Okay, so we have Black-Scholes down here. All right, let me take a little screenshot real quick. Let's bring some of these over here, these Black-Scholes formulas. Or we can even, I'll bring in the formulas for D1 and D2 as well if anyone's curious. So let's go back over here and paste this into here. So there's one thing that I also found and I should probably show where I'm getting some of this stuff from too. So if we go over to this area where there's the readings, like the concise readings, I've been grabbing a lot of stuff from basically over in that area with this like e-textbook. And I'm just going to go to the derivatives, and then it's got everything kind of sorted by the specific topic that you might be looking at. And so I was trying to find some information on like the Black-Scholes-Merton model and components and stuff. And one thing that I grabbed from in here for this question was a little note about ND2, which represents the risk neutral probability that a call option expires in the money, whereas 1 minus ND2, which is the same as N negative D2, represents the risk neutral probability that the put will expire in the money. So when we're looking at Black-Scholes option pricing model, we're basically doing this thing where, like with the call, this is the value of the call. We're taking the underlying price here, and we're multiplying it by this value ND1, which is another probability, right? Think of like D1 and D2 as basically z-scores, where we're going to take some possibility of distributions and then put in this z-score, right? If we did a z-score of 0, it might fall, say somewhere like on the mean, for example. And then we're basically trying to find what percentage of the outcomes happen in this cumulative probability distribution here and here. So for the ND2, that's going to be the one that represents that this option actually expires in the money. So we're doing this thing where we're figuring out some probability of the stock price being a certain value and multiplying it by the stock price. And then we're subtracting basically, it's almost like a cost of financing. The exercise price is treated as basically a 0 coupon loan. And then we're going to discount it back at the continuous compounding rate of interest and the risk-free rate and however much time there is to maturity. So in this question, we're asked, based on the information in Exhibit 1, which of the following is the most appropriate approach for valuing a 50 call using the Black-Scholes model? So we have our formula we can see here that we're really interested in using. We're multiplying the stock price is going to be multiplied by ND1. So we can see here, ND1 is this value. And then we're going to see the exercises price is going to be multiplied by, and then it's going to be, we see that this is an option, right? 0.6431. However, we see that the exercise price is multiplied by that ND2 there. However, that doesn't really tell us the whole story. So that's close to being right, but we still need to take the present value, right? We're going to discount it at the continuously compounded rate of return back to the present value of today. So the next one actually says the right thing, which is less the present value of the exercise price multiplied by ND2. So we should go with option B for that one. And so let's go back and see if we got that right. And yet we see that that is actually the correct answer, and that we identified kind of the different parts of this. And then this answer starts talking about like how they got D1 and D2. For now, I'm going to not go into that much depth, but that is how the Black-Scholes is using those 5 inputs to basically come up with what is these z-scores, like these probabilities of the options expiring in the money. And the math is a little bit complicated. If for who asked that question earlier about how do you actually go and like calculate these values like D1 and D2, I do have like an Excel video on my channel that's all about calculating and configuring Black-Scholes in Excel that you might be more interested in like diving into, where I kind of do all this stuff actually by hand. I think for the CFA, a lot of this stuff, you don't like, it's probably not going to be testable in my opinion, like about having to have memorized each individual part of that formula. I mean, maybe Sam or someone can correct me in the chat if I'm wrong, if that's like testable material now, like every part of that formula being memorized. But if we don't have any questions, I guess, we do. Okay, gotcha. Yeah. Okay, so we'll move on to the next question here, which is, of which of Hal's stated assumptions is least likely an assumption of the Black-Scholes model? So let's go take a look at basically all of these assumptions real quick. So we have this client, and they have a well-diversified equity portfolio. This share is their largest position. Okay, so to verify his understanding of the Black-Scholes-Merton approach to estimating option values, Hal states several of the assumptions upon which the Black-Scholes model is based. So we have these three assumptions. One is that options are continuously exercisable from purchase until expiration. The second assumption is traders have the full use of the proceeds from the short sale of the underlying asset. And the third assumption is that asset prices exhibit geometric Brownian motion and normally distributed returns. So there's a ton of assumptions about the Black-Scholes model, and that's what I was talking about earlier, is there's a lot of assumptions, and some of them just don't really hold up. Like, they make these broad sweeping assumptions about reality that won't really be true. But one thing that you should know about the Black-Scholes model is that it's based on European options, which means that they're only exercisable at expiration. It's not for American options, which would be exercisable at any point until expiration. So if we're talking about which of these stated assumptions is least likely an assumption, it would be that you could just exercise them whenever you want. That would be an American option, which they're not for. So I'm going to go with the assumption A. And then we can see that there's a nicely created table with all the various assumptions. You can, pretty much count like 12 different assumptions here. And so this is just almost one that requires like memorizing to get it correct. One thing that I should mention is I'm sure some people have seen from some of my videos where I shout this out, but I'm working with the company that provides this whole infrastructure and software here, UWorld. So I've actually made a bunch of lecture videos for them. So if in the product where you go and you see like lectures and stuff in here, a bunch of these lectures are going to be mine, especially at level 3, and then more and more of them are becoming my lectures as over time, as I start working on and building out and creating lecture videos for basically levels 1 and level 2. So we're going to keep adding more and more of mine. Like, you'll see basically how it works is you'll have like the reading on one part and then the lecture video like over here for each section. And UWorld's done something pretty nice for me, which is they've given me like my own landing page and basically a 25% discount for all of my people. So I pinned the link in the comment. It should be in the at the top of the comments. This is my first time live streaming, so I'm not totally sure on how all that works, but it's also in this live stream's description. So it's my landing page if you're interested in anything. The 25% off, Ryan 25, works on anything, and it doesn't have to be a whole course. I think you can pretty much just buy individual stuff, if you wanted mock exams or just QBank or stuff like that. But I specifically work on the lecture videos. So now let's keep it moving, and I'll go to question 4, which is, based on the information in Exhibit 1, a put on one share of Elephantine stock is best replicated by a portfolio consisting of... And so then we're just going back to Exhibit 1. This is going to be a similar question as what we had for the one that was basically that question 2. So let's open up what I had for this one. Okay, so let me grab that same formula. I still have it here. We'll paste it in. So we already looked at the call option. Now the put option is quite similar as the call option in that we use these probabilities, right? And remember we said that n negative d2 represents the risk neutral probability that a put expires in the money. So basically how this model is determining these values at like a super intuitive high level is it's trying to figure out like what's the probability that these models or these options expire in the money, and then working back to value that way. So in this one, we're being asked, how do we replicate it? So it's a question about basically replicating this payoff or basically this value of this put. So if we look at this, we would see that we have this like exercise price, right? That's discounted back to present value by a continuously compounded risk-free rate. And so when we're discounting it back, that's basically a zero coupon bond. It's like a zero coupon bond at the exercise price, and then multiplying it by the risk neutral probability that the put expires in the money. So we actually need to go long blank a certain number of shares of a zero coupon bond. So they all say that. But what is the amount that we would go long? So when we see this ND2, we can see even in this text here, this ND2 is going to be this N negative D2 is going to be equal to, and I got this from the chapters of the summarized notes in the product, but N negative D2 is equal to 1 minus N D2. And so we're given ND2, but we're not given N negative D2. So that's going to be easy to calculate. We can just take 1 minus that N negative D2, which should be 0.6431. And now that will give us that value right there of 0.3569%. And so this N negative D2, basically we're saying that, I shouldn't have put the decimal there. I'll put the decimal right here. We're saying that there's basically a 36% probability this put expires in the money right now, and that's kind of how we're determining the value. And then we need to short a certain number of shares of their stock. So we see right here, see this minus the underlying price and then N negative D1. So that's how many we're saying that basically this is like shorting the shares of stock. So how many would we do? Well, we don't have N negative D1, we have N D1. So we can do the same thing where we say N negative D1 is going to be equal to 1 minus N D1. Same thing as before. And then we're going to find that that is 1 minus the 71.86%, which is going to be that 28.14%. So that should give us the answer to this one. And just to reiterate, I mean, maybe if there's like people who joined on who didn't see before, like basically we're looking at all these possible outcomes. And when we're talking about like ND2 versus ND1, let's say we're drawing a line right here. This is like a cumulative probability distribution where like 64.31% of the observations are to the right of that dashed line. And then that means that for N negative D2, that would have to be the remaining observations of these 34 or 35.69% of observations need to be over here. So that's why it's 1 minus 1 gives you the other one. So let's go take a look, see if we got it right, and hit submit, and there we go. So let's see if there's anything valuable about. I think it's just pretty much saying exactly what I said up until this point. And looks like, oh, now let's jump to the next one. So this one is on the black model, and this one is most appropriate for valuing European call options on which of the following instruments. So let's take a look at what it's saying about the black model. This one, it's kind of funny that there's like the Black-Scholes-Merton model, which is the most popular option pricing model, and then there's another option pricing model called the black model. It's funny how the names end up, or maybe it's the same guy. Maybe somebody in the chat could like tell us why the names are so similar, and maybe it's like the same person who came up with both the names. But anyways, I wanted to go and grab something from the textbook to look up about this black model real quick. So let's go to derivatives and find where it's talking about the black option valuation model. And so here's the black model right here. And so the Fisher-Black futures option valuation model, or simply the black model, is applicable to options on underlying instruments that are costless to carry, such as options on futures and forward contracts. So when we say basically this like costless to carry, I think a big part of what that means is like the initial value of the instrument is basically zero at initiation. So when you enter into the position, like a futures contract or a forward contract, when you enter into it, it's going to be priced in such a way that the initial value is zero to both sides. So that means it's going to be costless to carry, and the black model will essentially apply to it. So if we go back to this one, the black model is most appropriate for valuing European call options on which of the following instruments? Well, we see in the definition, I kind of cheated by showing the definition, but we're going to see that the right answer is futures. And then if we think about like equities and currencies and stuff, these aren't really costless to carry, because think about like if you wanted to buy into an equity, you actually have to spend money up front. That has a cost. If you want to buy into a currency, that's going to have an output at some point up front. So we're going to go with futures, and we'll see that there's a kind of more in-depth detail about it down here. I'm gonna skip past that and go to the next question. One thing I should point out, if anyone's newly joining, so like I'm using the UWorld product for this one, and so they gave me my own like custom page with 25% off for everything. And in the chat on this, in the chat and on the video description, there's like a link with my name in it to get to that landing page if you're curious and checking out like some of those deals. So anyways, let's go on to question 6. Peak needs to sell a receiver swaption as part of the synthetic fixed rate funding strategy. When using the black model for valuing the receiver swaption, Peak's best choices are the... You know, one thing I want to point out, and I made a video about this like probably a month ago, but the way that I like solve these vignette problems where you get like this whole story and then they give you like the questions is I actually don't really go and just like read through this. The way that I found to be the most time efficient for me personally is like I'll just go and read the question, and then once I read the question, I'll just go like parse through to figure out what I actually need to know from all this information. And I feel like it is so much faster. Like when I first started studying for level 2, when I started studying in the first place, it was like you got 3 minutes a question, and I would like struggle to finish these questions in time. And then I switched to this method essentially where I'll just read the question, then go back to the problem, and then try to like parse through what I should actually like do with it. And once I started doing it that way, it's so much faster. And then I think when I actually was taking the level 2 exam, I would basically, I think like at that time, I know they like changed how many questions you take, but at that time it was like each part was 3 hours. And I think I basically finished in like 2 hours. And then I just had another hour to like sit there and basically go through and like check my work and double check all my answers and stuff like that. And I never would have been able to do that if I had stuck with the method of like reading through everything first. So anyways, that being said, let's go to this question where basically we're trying to sell a receiver swaption as part of a synthetic fixed rate funding strategy. And then when using the black model for valuing the receiver swaption, Peak's best choices are... So I would go back over here and I kind of just see this swaption thing, and then I would just start poking around at it down there and make sure I've not missed anything else that's like pertinent to answering that question. Let's go pull up what I saved for this one real quick. Okay, here we go. So let's talk about just like what a a receiver swaption is. So a receiver swaption is gives the buyer the right to become the fixed rate receiver and the floating rate payer on an interest rate swap. So basically, it's just an option to enter into like a plain vanilla interest rate swap in the first place. So then we see this text here from the actual vignette. M&S has been retained by this company, a AA company, for advice on debt financing alternatives. Peak is considering the issuance of a 5-year fixed rate bond. They can reduce, so they're suggesting they can reduce its effective funding rate by using synthetic non-callable debt that is created by issuing a callable bond and selling a receiver swaption. So the advisors uses the Black model to establish the terms of the swaption. And then we see that the actual swap rate is this 2.89%, and then the 5-year AA callable bond yield is 3.17%. So what of these options would we go with? Which is the best choice to value this receiver swaption? Would we use a corporate bond for the underlying instrument and a 2.89% exercise rate, which is that swap rate? Or would we use the interest rate swap as the underlying, a 2.89% exercise rate, which is the swap rate? Or would we just do the interest rate swap for the underlying and a 3.17% for the exercise rate? Well, this one I actually thought was like kind of a complicated and difficult one. So if we look at what I have down here, we're going to see that. So if you want to lock in this fixed interest rate at a lower borrowing cost, basically one thing you can do is, instead of issuing this non-callable fixed rate bond, you can issue a callable bond, because the callable bonds actually have that lower coupon rate because they provide like that advantage of being callable. So people are willing to take the lower coupon rate to invest in them, and then sell a receiver swaption to basically hedge against rates falling. So it's going to create this synthetic callable bond. However, unfortunately, if it's on this callable corporate bond, you're not going to be able to use the lower rate. You're going to have to use this higher rate. So the underlying is actually going to be this interest rate swap, and then the exercise rate is going to be the rate from the callable bond. I think this is like a really, really difficult question in my opinion, and like a difficult one to understand. And I think it takes some more time to basically read through all this explanation to really figure it out. And then, so we've basically worked through 2 of the initial vignettes, and then we'll get to this last one now, which I had planned, which is all about the binomial option pricing model. And there's really 2 main popular pricing models. One's the Black-Scholes, which we kind of covered a lot in these first 12 questions. And then now we'll get to the other popular one, which is the binomial option pricing model. And I'll just pause for a second to see if anybody has a question and take a sip of water real quick. I can feel my voice is starting to go. So it looks like we're good to continue. Let's go to this question. And there's not too much text about this one, actually just more information. So maybe we'll just read a little bit because there's not much to read. So we got a portfolio management firm. They invest in options to hedge equity positions. So we're analyzing the equity positions from these 2 companies, and the relevant information for each company is provided in these 2 exhibits. So let's take a look at this. Using a 1-period binomial model and the information in Exhibit 1, the value of the call with the $50 exercise price is closest to. So let's actually draw out basically this tree. So if you're not familiar with binomial models, it's kind of like we're taking a price and then we're assuming there's like 2 different ways it can go. So let's draw this out. So the current stock price is 50. And then we're saying this is basically at time equals 0, which is today. And then at time equals 1, so 1 year from today, we can either go up to a value of $56, or we can go down to a value of $44 for the underlying stock price. So using the 1-period binomial model and the information in this exhibit, we have to figure out basically what is the value of this call. So I'm going to go back to our formula sheet and grab the formula that we might need to answer this. So let me go see if I can find that. Okay, perfect. Here we go. I'm going to grab this right here. So this is the formulas for calculating calls and put values on this binomial option pricing model. I'm going to just paste it in right here. So basically what we're trying to do is we're trying to figure out what is the probability that this happens? What's the probability that the stock price goes up? And what's the probability that the stock price goes down? These are only the two possible outcomes. So this probability of this happening plus the probability of this happening should just be 100%. So that's why this down move probability is 1 minus the probability of this up move. So how would we calculate the probability of the up move? Well, we can actually use this formula right here. So let's write this out. So it's going to be equal to 1 plus R, which is the risk-free rate, minus the down factor divided by the up factor minus the down factor. So what is the up factor and the down factor, this UND here? So that's quite simple. So the up factor is just going to be equal to what's the amount that the value becomes when the price goes up divided by what is the value that it started at. So if we do this, we'll find that the value of this up factor should be 56 divided by 50, which is going to give us a value of 1.12. So our up factor value is 1.12. And then now we can do the down factor, which is going to be equal to this 44 divided by 50. So down factor value should be equal to, let's punch that in real quick. 44 divided by 50 gives us 0.88. So we got 0.88 for the down factor. We see up here our risk-free rate's 3%. So we can just start plugging stuff in, which is going to be equal to 1 plus 0.03 plus the down factor minus the down factor of 0.88 divided by the difference between the up factor and the down factor of 1.12 minus 0.88. Now that is going to give us, if I just do some mental math, that should be what, 0.15 over 0.24. It's dangerous when I start doing mental math like this. Let's see. So if that's right, that should be 0.15 divided by, you know what, I'm not going to even rely on my mental math. I'm going to do 0.013 divided by 0.88. That gives us 0.15, that's right, and divided by, no, that is 0.24. Divided by 0.24, I was right. See, guys, you just have to have more confidence in yourself sometimes. You know, that's my inspirational quote of this stream. So 62.5% probability of this basically going up to this value. And then a 1 minus that. Since I'm on a roll with the mental math, I'm going to say that's 37.5% probability of this down move happening here. And so now that we have those, we can actually plug this in to this basically expected future value of a call. So we know that there's this probability of this happening, and then so we can multiply basically this times this to get some value, and then we can multiply this value times this to get some value, and then we sum those two together, which gives us a weighted average of the two potential values. That's what this formula is doing. So it's going to be equal to 62.5% times that 56 plus this 1 minus that, which is going to be the 37.5% times the price of the call in the down move scenario, which is that 44. I gotta make it clear that we're multiplying that. So that's going to give us our expected value 1 year from today. So I can punch these in super quick. Let's do 0.625 times 56 equals that. And then we'll add the basically 37.5% probability that it becomes $44. So that's going to give us $51.5. Now that is the expected value in the future. So now what we need to do is we actually, that's the expected value of the, basically, I'm screwing up. Sometimes I'm just talking about some crap, guys. Okay, so forget everything I just said for a while there. So basically, instead of multiplying this by this, it's too long into the stream. I've been talking for an hour and 20 minutes straight. We have to figure out what is the payoff of the call when that happens. So this is actually going to be this 56, right? Like we have the strike price of, let's see, we have the strike price. It said, I think somewhere the strike price is 50, right? So if at this time we can exercise this for $50, really the payoff, I should be saying what the payoff is. So we can sell something for, or we can buy something for $50 that's really worth 56. So that payoff is actually $6. The 56 minus 50. This one we would not exercise. We're not going to pay $50 for something that's worth 44. So the payoff for this down move is actually only equal to $0. So now we need to basically multiply these probabilities by the payoffs, not the actual stock price. That was my mistake. So let's do 62.5% probability of a $6 payoff plus the 37.5% probability of a $0 payoff of those call options is going to be equal to, let me do some math real quick. It's going to be 6 times 0.625 is equal to the 3.75. There we go. But that's our expected value on this call essentially 1 year from today. So we want to take that value and discount it back to today, and we have the risk-free rate. So what we can do is basically we need to find the present value of this, right? So we got this. Now to get the calls price, we need to find the present value of that, which we can do by essentially taking e to the negative RT. Maybe that might not be somewhere where you guys can see it. I'm going to do C is equal to e to the negative RT. So that's going to be our discount factor times that, like this 3.75, which is the future value of the call. So it's going to be e to the negative 3% times 1 period into the future to discount it back. So if we do that, I'm going to go over here. I'll just store this 3.75 in the one slot. And then now let's get the 0.03 negative to the value of E. So that's our discount factor. We'll multiply that by 30.75 is equal to 3.64. And I'm happy to see that that is one of our available answers right there, 3.64. So let's go back over to here and punch that in for the first one. All right, perfect. So we got that right. You could follow along. It's really going to be similar to everything that I just did. And that's the 1 period binomial model. I think we'll get into one that almost takes it a step further and gets to 1 period beyond that. Okay, okay. So we have one that says, is using that calculator app much faster than doing it in Excel, or are you using it because of the exam situation? Okay, yeah, so this calculator app is way slower than doing it in Excel. Excel is way better than these little hand calculators. So in the CFA exams, you have to use these financial calculators. Maybe you guys can see this right here. So this is like the Texas Instruments BA2 Plus. I think there's other models that are available, but this is the most popular one that people use in the CFA exam. So I'm using this calculator because this one here is basically a direct replication of what is used in the exam. And so they force you to use these by hand calculators in the exam because it forces you to basically understand everything better this way. If I can use Excel, I can basically just put my formulas in and plug and chug that way, and that's much faster and much easier and much more automated. But using these little hand calculators kind of proves that you really know exactly what you're doing, right? So it's basically putting more of a mental load on your brain and less of a mental load on the computer. So I'll just jump into the next problem if we don't have any other questions for now. All right. So based on exhibits 1 and 3, so we have this information about this stock here, and then this information about this stock here. If Brooks believes that an arbitrage opportunity exists for the Alphatron call with the $55 strike price, which of the following is the most appropriate way to exploit the opportunity? So let's take a look at that. I created something that we can pop over here for. Here we go. So basically the last time we created all these, like we had all these values in terms of the up factor and the down factor and the probability. So I'm going to use my memory, which I believe the up factor was 1.12 and the down factor was equal to 0.88, I believe. Let me just really quickly make sure that I didn't screw that up. 56 divided by 50. Okay, and then 44 divided by 50 is going to be perfect, 0.88. And then we had the probability of the up and down movement. So we found that the probability of the up movement was that 62.5%. And so basically, because none of this stuff changed, like we still have this stock price, we still have this expected price in 1 year, we still have this expected price decline in 1 year, all the same stuff, we can use all these same values, same risk-free rate. So let's get back to this question. Based on exhibits 1 and 3, if Brooks believes that an arbitrage opportunity exists for the Alphatron call with the 55 strike price, which of the following is the most appropriate way to exploit the opportunity? So exhibit 3 shows the information for Alphatron options. All the options are European options that expire in 1 year. Each option allows the holder to purchase or sell 1 share of Alphatron common stock. And so here's the one we're looking at, which has the exercise price, because it specifically asked about the 55 strike. So we're looking at this. We see a call with 65 cents, and we see a put with $3.40. So let's figure out how would we go about finding our solution to this one. Okay, so we're using our same up factors and our same down factors. And now we just basically, what we want to do is figure out what do we think would be the call price of for the 55 strike based on the binomial option pricing model. We already have all this information. So what I'm going to do is just take in our formula over here one more time for everyone that hasn't memorized it. And we'll put that right here. So let's start writing it out. So we can use all these same values. We do need to come up with basically what are the payoffs if this happened, right? So we have to draw out that tree. So it starts at t equals 0, right, today, and that's going to be the $50, and then it could go up to 56, or it could go down to 44. That's in 1 year from today, or one period. Now, what's the payoff? So the last time we had that, we did that strike price of 50, but now the strike price is 55. So the payoff in the up scenario is going to be 56 minus the 55 exercise, which is going to be 1. And then for the down scenario, the payoff is going to be equal to the max of 44 minus 50, or 0, right? We're not going to exercise it if the price is worth less than the exercise for a call, so that's just going to be 0. So now that we have the call value in the upward scenario and the call value in the downward scenario, we can multiply by that probability of the up move of 62.5% times the $1 payoff in the up move scenario plus the probability of the down move, which is going to be that 37.5% times 0. And then we multiplied those together, and it's going to basically be 0.625. And that is the future value. So once again, we found our little future value, and now we need to discount it back 1 year. So it's going to be equal to this. Now we're going to do this. So the call value is going to be e to the negative RT. So we're discounting back at the continuously compounded risk-free rate times that future value of 0.625, which is going to be equal to e to the negative 0.03 times 1. We don't even need to put the 1 in there for t, times the 0.625. Let's punch that into our financial calculator. So it's going to be 0.03 negative to the second value of e. So that is our discount factor, multiply it by 0.625, which is going to be equal to basically 0.607. So we found that we believe that this call should be worth 0.607. We see that the value that in the market is this 0.605. So what should we do? We think that the call is overpriced, right? So if we think the call is overpriced, then we can go look at our answers. We definitely don't want to buy one. We're not interested in buying one because we believe it's overpriced. So we're definitely thinking about selling a call. So now we would sell a call, and now we're down between B and C. But if we're trying to basically arbitrage, we're not going to just like sell and sell. We can sell one call, and then we can buy the stock to offset it. So we can almost like fund the purchase of the stock by taking the premium of the call and applying it to buying the stock. So let's go with B for that one and see if we get that one right and hit submit. And there we go. I'll take a sip of water, pause for any questions, and then move on if there are none. Okay. And so, yeah, we're wrapping up the stream soon. I can fill out these last couple questions, even though it might go over what we originally said this stream would go for. But yeah, if there's any last questions that people have, now is a good time to like put them in the chat. So let's move on to the next question, which is question 3 that says, based on exhibit 2, today's value in US dollar of this company, so this one right here, exhibit 2, 2-year European put option with a 70 strike price is closest to, and then we have these 3 options. So let's go open up this one. Open up. I believe, was it question 3? Yeah. Okay. So now we're going to have to basically draw out a tree. And this is one where it's actually going to get more complicated because this is where we're getting into like a 2-step binomial. So let's start drawing out the tree. So we're going to have like a t equals 0. T equals 0, which is today. That is right now. The price is currently 80. Then we'll have in 1 year what it could become. T equals 1, which is going to be basically we have the up factor. So we know how much it goes up by if it goes up, which is going to be 80 times 1.4. So that's going to be equal to 112. And then it's going to go down. It could go down, and the down factor is 0.8. So that's going to be 0.8 times 80, which I believe is 64 off the top of my head. Let's see. Yeah, 64. And then now we're going to go out to 2 years instead of just 1. So we'll go one step further. Now it could go up and then up again. So if it went up the first time, the value is 112. So that's going to be equal to the 112 times the 1.4. So that would be 156.8. 156.8. Or it could go down from, it could have gone up and then down. So that's going to have been, if it did that, it would be 112 times the 0.8 should be equal to 89.6. Now, it could have gone down and then in the next period gone back up, which would end up in the same value. If you multiply 1.4 times 0.8, or you multiply 0.8 times 1.4, you end up with the same value. Or the worst, or this could have happened where the price has gone down twice. So once it's at that 64, it could then be multiplied by the 0.8, which would bring it to a value of 51.2. Let's do 51.2. Now that we have all of these, let's calculate or figure out what would be our payoff in any of these situations. So we're saying the strike 70. So today's value, and it's a put option. So puts actually benefit from the price falling. So this one, you wouldn't be able to exercise a put if the strike was 70 and the underlying price was 156.8. So the payoff would just be 0. Again, if the stock price is above the exercise, you can't exercise it. So payoff is 0 for this scenario too. The only scenario that really has any value is going to be if it goes down 2 times in a row essentially, which is going to be a value of 70 minus, so it's 70 minus this 51.2, which I think is 18.8. Yeah, 18.8. So yeah, $18.80. So now we basically have figured out all these possible payoffs. Now we need to figure out what's the probability of each of these payoffs actually happening. So we should figure out what is the probability of an up move at any given time. And we can use that same formula that we used before, which was basically the numerator, I think, was 1 plus R minus D, and then the denominator was R minus D. So if we go through and do that, we're going to be given 1 plus that 0.035. Sorry, I wrote that all not well. 1 plus 0.035 minus the D 0.8 over the 1.4 minus 0.8, which is going to give us, that should give us, I'll plug it in, but I think that's going to be 0.235 over 0.6. Yeah, it should be 0.235 over 0.6. So 0.235 divided by 0.6 is going to be equal to a 39.17 probability of an up move. So this should be, like, we could do a long formula or we could just use intuition. So this is like a 39.17% chance it goes up. So that means the chance that it goes down is going to be 1 minus that. So let me do this in the calculator. So make that negative and then we'll add 1. So that's a 60.83% chance it goes down. Now, this would have been harder if there was like payoffs on these ones, but because it needs to go down and then it needs to go down again, basically the only time it ever pays anything off is if this happens twice. What's the probability of that happening twice? Well, the probability of that happening twice is going to be basically this squared, or just, so it's going to be 60.83% times 60.83%, which is just 60.83% squared, multiplied by the payoff at the end is going to be 18.8 if that happens. So that's going to give us, let's see. So we can square that, multiply by the 18.8, and that's going to give us basically 6.96. So that's our expected like future value of this put option, but that's 2 years in the future. So we need to discount it back all the way to the value of today. So now we can take, to get the, the current value of the put, we take the present value of this, which is going to be, again, we're going to discount it by E to the, discount it by the risk-free rate, negative 0.35%. And now we're going to multiply it by 2 years instead of 1. And then multiply that 6.96 by that. It's going to be equal to Let's do that. Okay, so I'm going to store this in the one slot to recall later. We'll take 0.035 negative and multiply it by 2. Gives us this value, second E. So that's our discount factor, and we'll multiply it by 6.96, which is going to be equal to 6.49, which should be answer A. I'm always like happy after I do these super like convoluted questions to go and get my answer and then be like, oh, I'm so happy that this is one of the available answers. Okay, yeah, great, got it correct. That one is probably one of the more complicated ones that we'll work on. In the answer, they showed this like super long formula of like what you could use if there was more payoffs. Basically, let's say like in this one, if the payoff wasn't 0, you would have had to do 39.17% squared, because that would have had to happen twice to get that payoff, and then you would have multiplied it by the payoff. But since the payoff was 0, I just didn't do it at all. And then like for this one, the payoff was 0, so I didn't do it at all. But to get to this, you could have had 39.17% multiplied by 60.83%, or you could have had 60.83% multiplied by 39.17% to get to this payoff. But those are the same, so you can just multiply this times this and then multiply it by 2, see, and then multiply it by the payoff. But I skipped that because it would all just come out to 0 anyways. So I think we can let's see, a question. Okay, so we got a question. We will solve this for p plus plus and then bring it back to t equals 0, right? That's exactly what we just did. So the question was, will we solve for p plus plus? Actually, I think it's p minus minus, right? Because like I think p plus plus would be this one. Like it would be if the price went up twice, and then this is like p minus minus. Maybe Sam can correct me in the chat if I'm got that wrong, but I think we're really trying to get p minus minus and then bring that back. And yeah, I'll let Sam correct that. But I think basically the plus is like if it went up, and then plus plus is if it went up again, and then the minus would be like if it went down once, and then minus is if it went down, the price went down twice. And I could see why you would get that backwards if it was a put. Okay, let's move on to the next question. So Brooks' firm holds American-style put and call options on Omega Cis. Both options have 2 years until expiry and a strike price of 80. Based on Exhibit 2, so this exhibit, it would be advantageous for Brooks to exercise. So this one is like a little bit convoluted. So I think what it's saying is like that would we ever early exercise if they were American at any point? And so then one thing that like we can do is basically draw out a tree for both of them to figure out if it would ever have been advantageous to exercise this one. So let me open up the next question real quick, which is going to be on, I think it's question 4. Yeah. So we could draw a tree. So we're wondering if it's ever going to be advantageous to exercise either of these. And so basically there's some shortcut where it's like in general with calls, there's no real advantage to exercising them unless the asset was generating cash flow, like a dividend. And we can see that for this one, there's no dividend. So a shortcut to know that would never want to early exercise the call is that it doesn't pay a dividend. So we know C is not going to be right. So now we're between A and B. And now this is where we might actually like draw out a tree to solve this, where basically we'd figure out what's the probability of the up move. We already did that for this one. We know the probability of the up move is the 39.17%. And then now we can basically draw like our tree again to see if it would have at any point been advantageous to early exercise. So if we draw out our tree one more time, we're going to get, right, we don't actually have to go 2 steps. We only have to go 1 step because we want to see if would we exercise it maybe at either point. So right now it's 80. So if the strike price is 80 and the current price is 80, we definitely wouldn't early exercise the put right now. There's no way, because we wouldn't be getting any payoff. You can't exercise it if it's at the money. So let's see, what would it like go up to? I forget what it was off the top of my head, the up move, and to be honest, it doesn't really matter. So it's going to be 80 times 1.4 again, which is going to be equal to, I think, 112. So this is going to have, is this going to have any, like, what's our payoff at time 0 basically? And because the stock price would be above the strike price, that would have no payoff at this time for that one. However, if it goes down, that was, I think it was 80 times the, like, 0.88 essentially. And then that was, I think actually, okay, so we can take it 2 steps. I think we take it 2 steps, and then we can just go all the way to basically where we already did this, or I'm going to say that the payoff was basically like a 28.8 or something like that. It was if the price goes down twice, which I think was like 64 the first time, and then it goes down again to, let's see, 64 times 0.8. So it goes down to 51.2. 51.2. So if it's 51.2, then that means the payoff at that time, so after t equals 2, is going to be equal to that 28.8. Now, if it had gone up from there, or like down from there, I think that this would have been, I mean, we can do it, but I don't think it would be in the money, so I don't think we have to even consider it at all. So it's going to be 64 times 1.4. That's 89.6, and that's above the exercise price. So that wouldn't get exercised, so the payoff would be 0 here. This one would be some like high value, and the payoff would obviously be 0. So I'm not going to even spend everyone's time that way. So basically, the question is like, would it have been worth it to early exercise at this time? So if we early exercised at this time, what would we have gotten? At this time, if we early exercised, we would have gotten the strike price of 80 minus 64. So we could have early exercised it for $16. Would we have wanted to do that? Well, that depends on what's the present value of this, based on the probability that it could happen, go here, here, and then discount it back. So let's do that. So there was a 1 minus this probability of the price going up. So at this time in the future, the probability that the price, or sorry, I should say goes down. There's a 1 minus 39.17% probability that it goes down. And if that happens, you're going to have a payoff at that time of 28.8. But that is just 1 year in the future. So we have to discount it back to what would be the present value of that potential payoff at this time, which would be basically e to the negative RT, which is 3.5%, times t, which is 1. Now, if we punch all that into our calculator, sorry, my bad. This should not be divided by, this should be multiplied by. Can you guys tell I've just been doing these problems for 2 hours straight? Well, I guess that's like the exam day. You do these problems for 2 hours straight, so I really shouldn't complain about it. 3.5% to the t is going to be times 1. We don't really need to care about that. So let's see, what's the present value of this? That's going to be, oh my bad. That's going to be 1 minus 0.3917 equals that times 28.8 gives us that value. So this is basically the weighted average probability at this time. Now we have to discount it back to this value, or the value of this at that time multiplied by the probability that that happens. Now let's multiply it by, so I'm going to store it in the 1 slot. Then I'm going to do negative, so we'll take 3.5%, make it negative, second e, and then multiply it by, we'll recall that from the 1 slot. That gives us a value of 16.92. So this has a value of 16.92 present value at that time. So that present value of holding onto it is higher than the value of exercising it. So we wouldn't want to early exercise the put at that time either. So we're going to say neither option. So let's go ahead and choose neither option. And there we go. And I like this. It has a little table about like when you might want to early exercise or not early exercise. And this is really where you'll see like with calls that you don't really want to early exercise, especially if it doesn't pay any dividends or anything like that. So let's see if we can just finish out these last two problems here and we'll put a wrap on it. So which of Brooks' statements is correct? Let's look at the two statements. While talking with a colleague, Brooks makes the following statements about the expectations approach for valuing options. So this expectations approach is going to be similar to like the logic in the binomial option pricing model. So the expectations approach relies on the investor's subjective belief as to how the underlying asset will move. So basically all these values, like these up factors, these down factors, risk-free rate, all of this is implied from the market. It's not actually dependent on an investor's subjective belief. So you're using actual market mechanics to determine these values and not your own beliefs. So we would say that statement one is not right. And then statement two, the discount rate used for the expectations approach is not adjusted for the investor's risk preferences. Yeah, that's true, right? Because we're discounting by the risk-free rate. Risk-free rate isn't dependent on the investor's risk preferences. It's dependent on whatever would be the risk-free rate in the market, like let's say a 3-month treasury rate or something like that. So we would go with statement two as the correct answer for this one here. And then finally, let's go through to the last question. And Brooks is analyzing a 2-year put with a strike price of 88 on this stock. If the put can be exercised at the end of year one, the hedge ratio at time 0 is closest to. So this is one where we're actually going to have to pull a formula out of the formula sheet. So the hedge ratio has let's see if we can find it. Yes, right here. Okay, so this is going to tell us our hedge ratio. Let's grab it. This H stands for the hedge ratio. Now let me open what I had for this very final one. All right, here we go. I'm going to paste it in here. Let's get the hedge ratio and draw the tree. So let's draw a tree out. So we're analyzing a 2-year put with a strike of 88. And then so we can draw out this tree. We got time equals 0, we got time equals 1, and then we got time 51.2. Okay, so we got all of these, and then what we can do is basically calculate like these hedge ratios at let's say like time 1 or time 2. So if the put can be exercised at the end of year 1, the hedge ratio at time 1 is closest to. So that's why we want to find, because it can be exercised at the end of year 1, we want to figure out like what these hedge ratios are at this time. So let's do this one, and we're looking at the put one. So the put payoff here, the payoff would really be equal to 0 because you can't exercise that. Now what about the payoff at this time? We can't exercise it. The strike is 88, so we can sell something that's only worth $64 for $88. That's a $22, or would it be? Hold on, no, that's a $28 payoff. So it's 88 minus 64 is a payoff of 28. So now we can find our hedge ratio for both. So this hedge ratio is going to be at basically determined, I think, like one step ahead. So if we do it here, I think it's going to be this H, which is the value of the put in the, it should be like the up scenario, which is a 0, minus the value of this put or the payoff of the put in the down scenario, which should be the, I think this 28. So it should be the minus the 28, and then we'll divide it by this value of the stock in the up scenario, which would be the 112, minus the value of the stock in the down scenario, which would be the 64. So that will give us negative 28 over, and then let's see what 112 minus 64 is. 112 minus 64 is 48. I might have done this one incorrectly, I think. I did, because this is, sorry, I wrote this down wrong. This is 24, and I wrote 28. So let's make 24 follow through all the way through. So all these should be 24 minus the 48, which is going to get us to basically, I think a 0.5, a negative 0.5. So then our hedge ratio should be this A value of negative 0.5. Man, sometimes you got the answer right and you just like write it down wrong. So let's do that. And yep, we got it correct. Okay, perfect. So there's a little bit more explanation about all these. It could give you like a hedge ratio for if we wanted to look at this time. But yeah, we can see we got 0.5 right at that time. So anyways, guys, super, useful product. I'm in here with the lecture videos. You're going to be hearing me shout out this product and these courses like in some of my videos in the future. And it's going to be pretty useful product if you're studying for the CFA exam, especially for like this Q bank. And I think I like the concise, like summarized readings, the Q bank, and then obviously I would vouch for my own lecture videos. So once again, if you haven't heard me say it before, feel free to click on that pinned comment in the chat. I'm not sure how I should get to it from here, but you'll see my own landing page with 25% off all this stuff of what they normally sell it for. And so I hope you guys enjoyed the chat. I don't think I've got any more questions. And if you guys enjoyed this or you're watching at some point in the future and you want to do more live streams of any kind of like type of live stream, just let me know, and maybe this is something we could do like more regularly on the channel. So anyways, I think that wraps it up, and I hope everybody has a great rest of their day.